Hello, folks. Sorry for the delay. I actually just hit the live button and got the notification that we were no longer connected. So went through a really simple log on and here we go. So hello and welcome to A Merit Moment. For those of you that haven't met me, I'm JB Howard. And as promised, each of these, I should say, weekly Merit Moments are going to come with a Howard Homestead update, as I've always promised. So going back over the last few weeks, we've plowed 8 acres of fields in preparation for our fall planting. We've canned pickles and green beans from the garden. And when I say we, I mean the lovely Krista. The flower garden is in full bloom. She has made pillowcases for the family room couches. She's spun and woven all of those. And we've actually begun work on firewood. We need 10 cords of firewood each winter to feed 2 wood-burning stoves, if you can imagine. That gets us through the winter season, which at my house usually begins a little early in September. And finally, the hens. They're laying more eggs due to the cooler temperatures we've been enjoying. Now, as always, we're going to switch away from the homestead update, and we're going to switch gears here. So today, we'll have a quick lesson on capital gains taxes, because the proposed changes to tax law surrounding capital gains are going to be a huge deal for our country if they're adopted, if they're approved. So to be clear right from the beginning, capital gains taxes are not found inside of your IRA. They're not in your 401k. They're not in your Roth. Capital gains taxes are inside of accounts that are referred to often as non-qualified accounts. Non-qualified just means that they aren't your 401k or IRA accounts, which are qualified for tax deferral on an annual basis. A capital gain can be defined as the profit you gain from selling things like investments, a business, or other assets like cars, boats, or even real estate. So let me attempt to explain this a little bit better and even give you some examples. You will always buy something for a set price, okay? So if you buy an asset for $100, that $100 is considered your cost basis. If you hold on to that asset for a certain period of time and then you sell it for $150, now you have a $50 capital gain because you sold it at $50 above your basis. The capital gain is taxable on your tax return, not the full $150, but just the $50 gain. Very important. If you held that asset for more than a year, current tax law sets the capital gains rates at 0, 15, or 20%, okay? Tables from the IRS show that in 2021, if your taxable income is $40,400 or less, you fall into the 0 bracket. You'll pay nothing on those capital gains. If your income is above that $40,401 to $445,850, pretty big span, you're gonna fall into the 15% bracket on those gains. Above that income level, the $445,000, your rate climbs to 20%. Capital gains rates have historically stayed lower than other tax rates, mainly because keeping them low encourages investments, people investing dollars. This is good for the economy. This encourages people to buy stuff, create stuff, and invest in businesses. Now, one of the ways that President Biden is currently trying to raise tax revenue, which is drastically needed for his American Families Plan, is by changing the capital gains tax structure, all right? Michael Kahn from Accounting Today says that this new plan would tax long-term capital gains and qualified dividends of taxpayers with adjusted gross income of more than $1 million at ordinary income tax rates. Under that proposal, 37% would generally be the highest individual tax rate, all the way up to 40%, but only if the taxpayer's income exceeds $1 million or $500,000 for single taxpayers. All right. So the Green Book, taking a step further, said the proposal would be effective for gains required to be recognized after the date of the announcement. Let me try and unpack that. The announcement could then be interpreted as the date when the American Families Plan was first announced on April 28th of this year. I know that's a lot. It's a little confusing and circular, but we'll attempt to unpack that, as I mentioned before. What this means is that anyone who's married and makes $1 million or is filing separately and makes $500,000 a year will have a jump in capital gains to 39.6% compared to 0 or 15 or 20%. To most people, not a huge deal, not anything we're even going to consider. The majority of Americans won't fall into this income bracket, so they may shrug and move on and say, forget it, this doesn't affect us. But that doesn't actually mean they'll be unaffected by the other proposed changes that are part of this proposal if they become law. Excuse me. Another caveat with this proposal is that they're attempting to eliminate the step up in basis for the accounts. In the past, if someone has a highly appreciated asset, rather than pay capital gains tax, they would simply hold on to it until they pass away or die. And then it gets passed to their heirs. Once it's passed on, there would be a step up valuation done. And the price it was worth on the day it changed hands, at death in other words, would be the new purchase price. For example, if your mother invested in Apple stock very early on and then it had a huge appreciation, she can hold on to it and pass it on to you. Then your basis would be the value of the stock on the date of her death, not when she bought it. So you receive the stock, no capital gains due at death. Huge advantage in estate planning and building intergenerational wealth. So even if a person is in the middle class or lower class and they inherit an asset worth over $1 million, they'd be affected by removing the step up in basis part of the law. Here's another example. We've got an elderly person in a big city, if you can picture it that way. Let's say New York, closest to us. They pass away. They had bought their home for $80,000 many, many moons ago. As it currently stands, their heir or their beneficiary would be able to have a new base price for that asset on the day of their parent's death. Rather than the original $80,000 the parent spent on the house, the child's basis would be $5 million. Then when the child sold it for $5 million, they wouldn't owe any capital gains taxes. Under the proposed changes, the basis would not step up upon death. The child would inherit the home as well as the base of $80,000. Child sells the home, beneficiary sells the home, there'd be a capital gains tax on $4.9 million minus the first $1 million. So many people, again, would shrug this off and say it doesn't affect us because there's a consensus attitude that says you'll be left with plenty of money. You wouldn't really be getting otherwise, and you're still way ahead, even with all the taxes. But it gets worse, so bear with me. According to another recent article, Think advisors Robert Bloink and William Burns, in a surprise move, any unrealized asset appreciation would trigger taxation on the date of the owner's death, regardless of whether the beneficiary sells the property or not. This means there's also a proposal to tax unrealized capital gains at death. The leaders in government would like to make death the recognizable event. It's the trigger to trigger the taxes. So we'll attempt to translate that. Right now, death is not considered a sale, which is a recognizable event for capital gains taxes to kick in. But the proposal would mean that the transfer on death becomes a sale. So let's consider another scenario. We've got a child who stands to inherit property, always live with their parents. When the parent dies, ownership of the house is transferred upon death to that child. The full amount of unrealized gains, capital gains taxes, I should say. For example, the taxes in my earlier example on $4.9 million would be due whether the house was sold or not. So think about the farm families. Think about the business owner succession plans. How many people could come up with the money for that tax bill if they wanted to stay in the home or they wanted to stay on the family farm without selling the property, without selling the land? How long is it going to take to sell it? How quickly are taxes going to be due? So the final part of this proposal was stated in the quote from Michael Kahn again. If you remember, he said the proposal would be effective for gains required to be recognized after the date of the announcement. However, that announcement could be interpreted as when the date the American Families Plan was first announced on April 28th, or is it when it gets approved? This means no one really knows when the provisions of the bill are going to take effect. If they make it a retroactive date, for instance, back to this spring, is that an attempt to close any loopholes for someone with a large asset now deciding to sell it under our current capital gains law? There's certainly a lot to consider with these proposals and a lot we just don't know. One hopeful thought on all of this, the proposal still has to gain enough votes in Congress to become law. It's not a done deal. We don't know what's coming down the road in that regard. However, If you stand to gain or plan to leave a sizable inheritance, you may want to meet with a tax professional. You may want to meet with a wealth strategist and discuss your options as soon as possible. That said, even tax advisors aren't certain which way things are going to go right now. This is certainly something we should all be keeping an eye on and considering as Congress begins the process of voting on these issues. I'll certainly be watching this closely and updating these materials as we go along as things become more clear. So with that, that's an attempt at explaining capital gains and the attempted changes on capital gains taxes and the proposed removal of the step up in basis and how that might not just affect the wealthy, but all of us. So with that, come back next week. We're going to be discussing the Secure Act and the proposed changes currently in Congress. The Secure Act was passed back in January of 2020, and there's already changes being made to that. So I know, and I will admit, none of this is super exciting stuff, but I think it's important to stay informed as these movements really begin to happen and things are changing. So thanks for joining me today. As always, hope to see you next Thursday at 3 p.m. for another Merit Moment. Thank you all so very much. Appreciate your time.